Good morning and welcome to Almas Market Mornings, your daily dose of global financial updates. There was some relief for both the yield watchers as well as the oil watchers as both of them corrected down yesterday. We had currencies rallying against the USD, fallen yields. But just to remind everyone, even if dollar index closes where it is now, this week would be the 12th weekly consecutive rise in the dollar index, matching the 2014 record. We still have 2 full days of trading ahead of us and some data which can drive the markets. Morning, JK. Relief for the inflation watchers as oil corrects. What's your take?
Good morning, Swaraj. Yes, I think it was a relief for most of the financial markets from the yields. Of course, the focus of the market is mostly on yields, and yesterday it was a big action because we hit new 16-year high in the US long-term yields, both 10-year and 30-year. 30-year, in fact, touched the psychological 5% mark. Then we had the German yield that touched 3%, and the UK 10-year yields touched a high that was last seen in 1998. So that was the action. But then there were some triggers why these yields came down because we had underwhelming Eurozone retail sales number that was first trigger, and then we had the data from US which showed the private job creations falling by almost 50% compared to last month. So it was at 89,000. That is the lowest count since January 2021. So this actually now contrasts quite a bit with Jolt's job opening data that we talked about yesterday, which came more than 9 million. But we had also indicated that Jolt's data was not so much reliable because of a small sample survey, and also the higher number last month was actually preceded by 3 months of consecutive fall. So definitely there are signs of employment situation in US easing away. Although we still have the ISM reports which show the manufacturing as well as services side employment indicators being high. But we would rather look at the non-farm payroll, which is the final number that the Fed would rely upon. We are also seeing the weekly jobless claim that continuously is falling. So we still do not have a very 100% clear picture on the employment situation, but definitely there are signs of easing. That's one thing that the markets took heart from, that bond yields market. And the other big factor was the oil price that fell almost $5 from yesterday's high, and it's now almost 10% down from where it was, more than 10% down from where it was in the recent peak. And so that gave much relief to the markets because oil price falling would be an indication of inflation going forward, also not rising or rather easing actually. Now, oil price fall was following the reports that Russia may lift its diesel ban in the coming days, and also the US government data that indicated weak demand for gasoline. In fact, the crude stocks at Cushing, Cushing in US rose for the first time in 8 weeks. So altogether, these triggers were enough for the people who were heavily short in the bonds to buy back. And what better level than 5% for the 30-year and close to 4.90 for the 10-year. So we had a relief rally in the stocks also, although gains were mostly limited to the Nasdaq index, which closely tracks the rates situation, and also the currency itself also took some heart from the easing in the yields. Currency also took heart from the fact that other data from US were not so encouraging. Like ISM report was just as expected, and there was no major jump there. And what I looked at, interestingly, was that the mortgage applications that fell 6% in the latest report, and this was because we have mortgage rates at 7.53%, which is a 23-year high. Then we also had other surprises in the UK data. where the services data came much higher at 49.3, services PMI that is, much higher than they expected. And last month's number was 47.2. And similarly, even Germany showed a jump in the services side. In fact, Germany's PMI services jumped to 50.3, which is an expansion territory. So altogether, it was relief for these currencies, which had been, as you said, falling for the last 10 weeks. And of course, dollar yen was capped because of fears of intervention, and just above 149 proved to be a cap, and we are down below 148.50. Not a big move, but at least it's not rising. And EM currencies also took heart from these moves. So what we expect further is whether we have more weakness in the US economic data. That would be a trigger for much more correction in the yields, or whether we have actually topped. That is what we would like to see in the coming months. There are reasons to believe that the economy is going to slow down substantially. As I said, market rates at 7.53%. Similarly, businesses are having to pay much higher rates now for their financing needs. And this is apart from the fact that consumers are paying higher rates, and the student loan repayments have started this week, leaving less money with consumers to spend. So all in all, we can expect a gradual slowdown in the US economy, and that should help the yields come down. And in fact, the Market Watch tool shows that the expectation of any rate hike in November or December have fallen even further, and they are now close to 25% probability. Coming to rupee, again, a very narrow range. There were some attempts to break higher, minor break higher, but then it was spotted by, once again, by the central bank actions. And we have a policy coming up tomorrow from the MPC, and no change is expected. But again, the forecast on inflation and growth, and also how they deal with the liquidity, which continues to be tight even after relaxing the earlier additional CRR requirement. So that is something that the market will look forward to, and also the forward guidance, because of the recent rise in oil prices. But my expectation is that this policy could be mostly a status quo policy, both growth and inflation likely to be maintained at the previous forecast, and rates to remain unchanged. And of course, if we looking at the global trend of inflation, which is showing a steady fall, one should expect the next move from RBI to be a cut, but that is quite far away in my view, because our inflation is closer to 7%, as against the upper limit of 6%. So rupee, no indications of break on either side. Very strong demand. FI outflow continues to be strong this month also, following September, which saw nearly 1.7 billion of outflow. So until we see a break of 83 on the downside or 83.35 on the upside, we should leave with the small ranges on the rupee. Finally, just to talk something different, we have had a rate cut by Polish central bank yesterday. This was the second rate cut they did, 0.25%. Before this, they cut rate by 0.75%. Brazil was the other EM central bank which had cut rate twice. So it's a world where monetary policy is taking a slow turn on the to the other side. Of course, these cuts are coming from central banks who have maintained rates at much higher levels. But yes, I think if inflation starts easing, we should start seeing more central banks. Mexico is the closest one to that. So we'll look forward to how the inflation and the monetary policies evolve in the coming months. Thank you.
Thank you, JK. And of course, the major theme yesterday was the 30-year US yield hitting the psychological mark of 5%. But when it comes to the US data, private job creations in US fell almost by 50% compared to the previous month. And there are some signs of the tight labor market easing. But of course, markets will be now keenly looking at the non-farm payroll, which is something the Fed would also be watching. Oil prices fell based on rumors of Russia lifting the diesel ban. And when it comes to some economic data, there was some mixed picture when it comes to PMI of Europe and UK coming better than expected. So The narrative would now shift to markets observing whether there is some weakness in US data, and that would be closely tracked. For rupee, we continued in a narrow range with some attempts to break higher, but it was capped by central bank. MPC outcome tomorrow will be closely tracked by the markets. And we all know how important flows are for the rupee market, and there have been a lot of talks post the JP Morgan government bond index inclusion. We at Almas have a very interesting webinar on the bond index inclusion being delivered by a solid lineup of speakers, including one former RBI executive director and an eminent economist. So do tune in on 12th of October at 5 p.m. to get insights into the bond index inclusion. Thanks for listening.